My name is Marisol Delgado. I am 29 years old, and I used to believe that if I worked hard enough, quietly enough, and long enough, my father would eventually see me the way he saw my stepbrother Grant, as someone worth consulting before a decision was made. I was wrong about that the night he called me from the resort's main terrace to tell me I was no longer welcome on property I had spent 4 years helping to save. The thing I had with me when I walked into that conversation was a manila folder. What was in it was not what any of them expected. But I should back up. My father, Raymond Delgado, built Sterling Properties from a single extended-stay motel outside of Flagstaff into a regional hospitality portfolio that, by the time I was 22, included 4 hotels, 2 boutique resorts, and a conference center in Scottsdale that hosted pharmaceutical conventions and the occasional regional trade show. He was proud of all of it. He talked about it the way other men talked about their children, with a specific, proprietary warmth that left no room for anyone else's contributions. I had been working inside Sterling Properties since I was 19, first as a summer accounts assistant while I finished my finance degree at the University of Arizona, then full-time after graduation as a junior analyst in the Capital Structure Division, a title that sounded more formal than the reality, which was that I reviewed debt covenants, tracked balloon payment schedules, and flagged anything that looked like it was drifting toward a covenant breach before it became a crisis. The division had 2 people in it when I joined. After 2 years, it had 1 because the other analyst left for a commercial bank and my father decided, without telling me, that his departure was an opportunity to reduce overhead rather than replace him. If you're watching this right now, I want to ask you something. Think about whether you've ever worked somewhere or lived somewhere where the people in charge had no idea what was keeping the lights on, where the person doing the quiet, invisible work that held everything together was also the last person anyone would think to thank. If that sounds familiar, stay with me. 'Cause this story is about what happens when that invisible work finally becomes impossible to ignore. That was the first time I understood what I was to Sterling Properties. Useful but not necessary in any way that required acknowledgement. The flagship property, the one that mattered most to my father, the one he brought clients to and photographed himself beside for his LinkedIn profile, was the Anderson Ridge Resort outside Sedona. 47 rooms, a spa building my stepmother Carla had personally overseen the renovation of, a restaurant that had been written up twice in regional travel publications, and a debt load that, when I inherited the file from the departing analyst, made me sit very still at my desk for about 30 seconds before I started reading it again from the beginning to make sure I hadn't misunderstood. I hadn't misunderstood. The resort carried a commercial mortgage originated 6 years earlier at a regional bank that had since been acquired twice, which meant the servicing had migrated through 2 different institutions, and the current loan holder was a commercial real estate debt fund out of Phoenix called Meridian Capital Partners. The terms were not unusual for the time they were written, but they included a variable rate component tied to a benchmark that had moved significantly since origination, and there was a covenant tied to the property's debt service coverage ratio that my father, based on everything I could see in the financials, did not fully understand. He understood that there was a mortgage. He did not understand that the mortgage had conditions that, if the resort's operating income dipped below a certain threshold for 2 consecutive quarters, would give Meridian Capital the right to accelerate the full balance and demand repayment within 90 days. The resort had just completed its first of those 2 quarters. I kept that information in a folder on my desktop and said nothing to my father yet. I wanted to understand the full picture before I brought it to him. That was how I worked. I didn't raise alarms until I knew what I was actually looking at. The Anderson Ridge Resort held a quarterly owners' meeting every 3 months, and by the time I had been inside Sterling Properties for 2 years, I had attended 6 of them as a support analyst, meaning I prepared the materials, built the financial summaries, and sat at the far end of the conference table with my laptop open in case anyone needed a number clarified. My father sat at the head of the table. Grant sat to his right. Grant was 34, the son of my father's first wife, and his official title was Director of Guest Experience, which meant he managed the general managers at 2 of the smaller properties and spent a significant amount of time talking about brand identity, guest satisfaction scores, and a rebrand initiative that had been in planning for 18 months without producing anything I could point to. The meeting in question was a Tuesday afternoon in March, and I had flagged, on page 4 of the 12-page summary I had prepared, a preliminary note about the debt service coverage ratio at Anderson Ridge. I had kept the language measured. I had written, The DSCR for Q4 came in at 1.08, below the covenant threshold of 1.20. If Q1 tracking continues on its current trajectory, this may warrant a conversation with our current lender. I had not used the word acceleration. I had not used the word crisis. I had written may warrant a conversation, because I knew my father, and I knew that if I introduced a problem too sharply, he would spend the first 15 minutes of any discussion deciding whether the problem was real before he could hear anything else about it. He flipped past page 4 without stopping. I watched him do it. He turned page 3 to page 5 the way you turn pages in a magazine you're browsing rather than reading, and I felt something tighten behind my sternum. Not quite dread, more like the physical sensation of watching something slide toward an edge in slow motion and knowing that reaching for it will only be interpreted as an overreaction. Grant said something about the spa renovation's impact on repeat bookings. My father nodded. My stepmother, Carla, who attended these meetings as an informal participant rather than an officer of the company, mentioned that she had been in contact with a designer about refreshing the lobby furniture. I waited until page 4 would have naturally come up in conversation. It did not come up. After the meeting, I stopped my father in the hallway outside the conference room. I told him I wanted to walk him through the DSCR note before he left the building, that it was time-sensitive, that I thought we had somewhere between 60 and 90 days to get ahead of it. He looked at me for a moment with the particular expression he used when he had already decided not to engage with something and was simply waiting for me to finish. Marisol, he said, I've been managing debt on these properties for 20 years. I appreciate the work you put into the summary, I do. But I think you're reading a number out of context. The resort had a soft quarter. Every property has soft quarters. I said, the covenant doesn't make exceptions for soft quarters. He said, talk to Grant about it. He has a better feel for the operational side. I stood in that hallway for a moment after he walked away. I folded the summary I was still holding into a smaller square and slid it into the pocket of my blazer and said nothing to the empty corridor. Grant did not have a better feel for the operational side as it related to debt covenants. Grant did not know what a debt service coverage ratio was. When I sat down with him 2 days later and explained what I was seeing, he listened with the expression of a man who is performing attentiveness and said, I'll mention it to Dad. Then he mentioned it to my father in the context of a dinner conversation, stripped of all numerical specificity, and my father told him he'd look into it. My father did not look into it. What my father did over the following 6 weeks was approve a $180,000 contract for the lobby furniture refresh that Carla had mentioned. He signed off on it without routing it through my desk, which would have been the normal process for any capital expenditure over $50,000. I found out about it when the invoice arrived in the accounts payable queue and I had to figure out which cost center to charge it to. I added the expenditure to a separate spreadsheet I had started keeping. The spreadsheet had 3 columns, date, amount, and notes. The notes column on that entry read, approved without DSCR covenant review, reduces available cash buffer for Q1. The lobby furniture contract wasn't the first time my father had made a decision that affected the financial health of Sterling Properties without consulting me. It was simply the most expensive one in a single line item. I want to go back further because the pattern did not begin in that conference room in March. It began earlier than that, and understanding it requires understanding what my role inside the company actually looked like in practice, as opposed to what it looked like on paper. When I was 23, the year after I graduated, Sterling Properties was carrying a note on the Flagstaff property that was 2 months from its maturity date with no refinancing in place. The original lender had been acquired, the servicing had transferred, and the new servicer had sent a notice to an address that was 18 months out of date. Nobody had received it. I found the maturity date while auditing the debt schedule as part of a routine review I had started doing quarterly because no one had been doing it at all before I arrived. I called the servicer myself, negotiated a 60-day extension, sourced 3 competing refinancing proposals, and presented them to my father with a recommendation. He approved the one I recommended, signed the documents, and the Flagstaff property was refinanced without interruption. He told Grant about the close call at dinner that same week. He said, "We almost had a maturity default on Flagstaff, can you believe that? Good thing we caught it in time." I was not at that dinner. The following year, the conference center in Scottsdale lost its primary anchor tenant 2 months before a major pharmaceutical convention that had been booked as a revenue anchor for Q2. The tenant exited on a break clause, and the contract had been written, before my time, without a termination fee that was worth pursuing. I spent 11 days building a replacement revenue model, sourced 4 alternative anchor tenants, and negotiated a short-term agreement with a regional medical devices company that covered 62% of the lost revenue for the quarter. My father called the outcome a strong recovery. He presented it at the next owners' meeting as an example of Sterling Properties' operational resilience. He did not say my name. There was a smaller moment, less dramatic, but somehow the one I returned to most often when I was lying awake running numbers in my head in the months that followed. I had built a rate sensitivity model for the Anderson Ridge Resort 2 summers earlier, a tool that showed how changes in the benchmark rate would affect the variable component of the commercial mortgage across different scenarios. It was not a complicated model, but it required pulling historical rate data, mapping it against the loan terms, and calibrating the outputs against the property's actual revenue history. I spent a long weekend on it. I sent it to my father on a Monday morning with a note explaining what it showed and why it mattered. He forwarded it to Grant without responding to me directly. Grant brought it up in a meeting 3 weeks later as something he had been looking at. He stumbled through the explanation of what the model showed. I sat at the far end of the table and said nothing and looked at the surface of the conference table while he spoke. I kept building things. I kept flagging things. I kept the debt schedule current and the covenant tracker updated and the refinancing calendar populated with lead times and lender contacts and notes on which relationships were warm and which would need work. I tracked the balloon payment on the Scottsdale Conference Center, $2.1 million due in 14 months, and began preliminary outreach to 3 lenders, not because anyone had asked me to, but because someone had to do it 12 months before the due date or it would become a crisis 6 months out. I had prevented a maturity default on the Flagstaff property and saved the company an estimated $340,000 in penalty interest and legal fees. I had built the replacement revenue model that kept the Scottsdale Conference Center out of a covenant breach during the anchor tenant loss quarter. I had maintained the debt covenant tracker across all 6 Sterling properties for 3 years without a single missed threshold notification. I had identified the DSCR issue at Anderson Ridge 11 weeks before it would have become an event of default under the loan terms. None of this appeared in my performance review, which was conducted annually by my father in a conversation that lasted, on average, about 20 minutes and ended with a number that was the same as the prior year's number because, as my father explained the first time I asked about it, the company preferred consistency in its compensation structure. I asked Grant once what his compensation structure looked like. He smiled in the way that meant he wasn't going to answer and said, "Come on, Mari. Dad takes care of us." I had not been called Mari by anyone at Sterling Properties except my father and Grant and Carla. I had not asked any of them to call me that. The rate sensitivity model I had built was still in use. I knew because I could see when files were accessed in the shared drive, and that particular file had been opened 41 times in the 2 years since I built it. My name did not appear on it anymore. At some point, I did not know exactly when, the file had been resaved under a new name that did not include my initials in the version tag the way I had originally formatted it. I noted that too. I noted everything. The Meridian Capital Partners situation came to a head on a Thursday in late May, which was also, in a coincidence that felt almost too on the nose to believe, the same week that Carla sent out the invitations for the Anderson Ridge Summer Gathering. The gathering was an annual tradition. 4 days at the resort, family only, the kind of event that had its own email thread and its own set of expectations around who brought what and who stayed in which rooms. I had attended every year since my father had married Carla when I was 17. I had never been asked whether I wanted to attend. My presence had simply been assumed, in the way that certain things are assumed about people who are useful without being celebrated. The email arrived on a Tuesday. It was addressed to Grant, to Grant's wife, to Carla's daughter from her first marriage, to Carla's daughter's husband, and to my father. The subject line was Anderson Ridge, Summer 2024, Family Week. I was not in the to field. I was not in the CC field. I read it twice. Then I opened a new message window, typed a reply to Carla asking if I had been accidentally left off the list, and sat with my cursor in the send field for long enough that my screen dimmed. I did not send it. Instead, I went back to the Meridian Capital file, because the situation there had shifted in a way that required my full attention, and because I had learned, over the course of 4 years at Sterling Properties, that the work was always safer to return to than the feelings. What had shifted was this. Meridian Capital had completed their Q1 review of the Anderson Ridge loan file, and had sent a formal notice of covenant breach to the company's registered address. The notice triggered a 60-day cure period, at the end of which, if the DSCR had not returned to 1.20 or better, Meridian had the right to accelerate the full remaining balance of the mortgage. The remaining balance was $4.3 million. The notice had arrived 2 weeks earlier. My father had received it, signed for it. I could see the delivery confirmation in the mail log, and had not mentioned it to anyone in the finance function. He had not forwarded it to me. He had not asked Grant to look at it. He had placed it, as far as I could tell, in a drawer somewhere, and assumed that the situation would resolve itself the way he seemed to believe most situations resolve themselves, which was without requiring him to engage directly with the mathematics. I pulled the notice. I read it. I read the loan agreement again, the full document, starting from page 1. Then I did something I had been thinking about for 6 months. 3 months earlier, during the routine lender relationship outreach I conducted as part of the refinancing calendar I maintained, I had taken a meeting with a portfolio manager at Meridian Capital Partners named David Osei. The meeting had been arranged under Sterling Properties letterhead as part of my normal scope of work. But during that conversation, I had asked David Osei a question that was slightly outside my normal scope, which was whether Meridian Capital ever sold performing or partially performing loans out of their portfolio as a way of managing concentration risk. He had said that they did under the right circumstances. I had asked what the right circumstances generally looked like. He had explained them to me in general terms over the remainder of the meeting. I had taken careful notes. Over the following 3 months, while I continued to maintain the covenant tracker and the refinancing calendar and the debt schedule and all the other invisible infrastructure that kept Sterling Properties from sliding into technical default on a rotating basis, I had been researching what it would take for an individual buyer to acquire a commercial real estate loan from a private debt fund. I had spoken, outside of business hours, with 2 attorneys and a commercial real estate broker. I had reviewed the Meridian Capital Partnership documents, which were publicly filed, to understand their redemption and liquidity mechanics. I had calculated, based on the loan balance and the property's current condition, what a distressed loan buyer would likely pay to acquire the Anderson Ridge mortgage from Meridian Capital at a discount. The number I arrived at was $3.1 million. I had $310,000 in savings, accumulated over 4 years of flat compensation and very few personal expenditures, because most of my personal expenditures had been quietly absorbed into my work. The home internet, the financial data subscription I paid for personally when my father declined to approve the budget line, the miles I drove to lender meetings in my own car. $310,000 was not $3.1 million. But I had also spent 3 weeks talking to a commercial real estate lender about a personal acquisition loan, and I had been pre-approved for $2.9 million based on my professional history, the asset value, and a detailed financial presentation I had prepared for the meeting. $310,000 plus $2.9 million was $3.2 million, which was enough. I had not done anything yet. I had only prepared. I had only made sure that if I ever needed to act quickly, I would be able to. The Carla email sat in my drafts folder, unsent. The Meridian notice sat in the file on my desktop, annotated. Then, on Thursday, the text message arrived. It came from Carla's number, not from a shared family thread. It was addressed only to me. It said, "Marisol, just to let you know we're keeping the summer gathering to immediate family this year. Nothing personal. Hope you understand." My chest went tight for a moment. A single breath held, then released. I set my phone face down on my desk. I looked at the Meridian Capital file. Then I picked up my phone and called David Osei. David Osei called me back on a Friday morning, 9 days after I had left him a voicemail. I had spent those 9 days the way I had spent most of the previous 4 years, quietly at my desk doing the work that needed doing. I updated the covenant tracker. I drafted a preliminary refinancing memo for the Scottsdale balloon payment, 14 months out, and sent it to my father's inbox without expecting a response. I attended a Thursday morning operations call where Grant talked for 22 minutes about a new pool towel branding initiative at Anderson Ridge. I took notes on the call the way I always took notes, in a numbered list, and then I closed the document and opened the Meridian Capital file and read it again. When David Osei called back on Friday, he told me that Meridian Capital's internal credit committee had approved the sale of the Anderson Ridge loan to a qualified buyer at a discount to the outstanding balance, subject to the buyer's ability to demonstrate funds and close within 45 days. I told him I could demonstrate funds and close within 30. The purchase closed on a Wednesday. I signed the documents in the offices of the attorney I had retained 3 months earlier, a woman named Patricia Solis, who specialized in commercial real estate acquisitions and who had reviewed the loan documents with me twice before I committed to anything. The wire transferred that afternoon. The assignment of the mortgage was recorded with the county the following morning. By Thursday, I was the holder of the commercial mortgage on the Anderson Ridge Resort. I did not call my father. I did not tell Grant. I went to work on Thursday morning, sat at my desk, and began drafting the formal notice that, under the terms of the loan agreement, the new lender was required to send to the borrower within 10 business days of an assignment. I spent 2 hours on the wording. Patricia had given me a template. I followed it closely. The notice was factual, civil, and precise. It informed Sterling Properties, LLC, the borrower of record, that the commercial mortgage on the Anderson Ridge Resort had been assigned to a new holder, that the existing covenant breach remained uncured, and that the 60-day cure period established in the original breach notice continued to run from its original start date. It included contact information for the new holder's designated representative, which was Patricia Solis's office address. I printed the notice. I signed it. I sealed it in an envelope addressed to my father's attention at Sterling Properties' registered office, and I handed it to the front desk for certified mail. Then I waited. My father called me on a Monday afternoon, 8 days after the notice would have arrived. I was in my office with the door closed, running a rate scenario on the Scottsdale refinancing, and when his name appeared on my phone, I let it ring twice before I picked up. He said, "Marisol, I need you in the conference room. Right now." I said, "I'll be there in 5 minutes." I squared the papers on my desk before I stood up. I picked up my copy of the loan assignment documents, which I had kept in the manila folder in my desk drawer, and I carried them with me down the hall. My father was already in the conference room when I arrived. Grant was there. Carla was there, which was unusual. She rarely appeared at Sterling Properties' offices outside of the quarterly meetings. All 3 of them were standing rather than seated, which told me something about the energy in the room before I had even crossed the threshold. My father said, "What is this?" It was not a question. He held up the notice, a single page, and his hand was not entirely steady. I sat down. They remained standing. "It's a notice of assignment," I said. The Anderson Ridge mortgage was sold by Meridian Capital. The new holder sent the required notification under the loan terms. "Who bought it?" Grant said. I set the manila folder on the table. I took out the assignment document and placed it in front of my father. "I did," I said. The room was quiet for a moment that lasted longer than it should have. Carla said, "That's not possible." "The assignment is recorded with the county," I said. "Page 3 has the recording confirmation number if you want to verify it." My father sat down. He sat down the way a person sits when their legs have made the decision before their mind has. He picked up the document and looked at it and set it back down. Grant said, "You can't do this. You work for us. There's a conflict of interest, there has to be." "I consulted 2 attorneys before I proceeded," I said. "I'm not an officer of Sterling Properties. I'm an at-will employee with no fiduciary duty to the company outside the scope of my employment. Acquiring a loan from a third-party lender is not prohibited by my employment agreement." I checked. My father looked at me. His expression was the one I had seen in the hallway outside the conference room after the March meeting, but the certainty that usually accompanied it was gone. What was left was something I did not have a name for and did not try to name. You did this because of the gathering, he said. Because Carla sent that text. I looked at him for a moment. I did this because the DSCR on Anderson Ridge crossed the covenant threshold 11 weeks before I brought it to you in that summary. I did this because you forwarded my rate sensitivity model to Grant without responding to me. I did this because I refinanced the Flagstaff property and you told Grant about the close call at dinner and didn't mention my name. I did this because I've been maintaining the infrastructure that keeps this company out of default for 4 years, and my compensation has not changed once in those 4 years. I paused. The gathering, I said, was just the last thing. Grant started talking first, which was what Grant did when he was uncomfortable and didn't know what else to do. He said something about loyalty, about family, about how this was not how you handled a grievance inside a family business. He said it in the register of someone reciting a principle he had never actually had to apply to himself. I let him finish. Then I said, "You told me once that Dad takes care of us. Do you want to walk through what that looked like from where I was sitting?" He didn't answer. I opened the manila folder to the second tab, which was not the assignment document. It was a 3-page chronological summary I had prepared over the previous 2 weeks. Not for the purpose of presenting it here necessarily, but because I had needed to write it down somewhere to see it clearly for myself. I had brought it because I thought I might need it, and I had been right. I did not hand it to anyone. I read from it. March 4 years ago, I said. You told me to talk to Grant about the Flagstaff maturity default because he had a better feel for the operational side. What I was actually doing was calling the servicer myself, negotiating a 60-day extension, and sourcing 3 refinancing proposals. The one I recommended saved the company an estimated $340,000 in penalty exposure. My father said nothing. 2.5 years ago, I said. The Scottsdale anchor tenant exited on a break clause. You described the outcome at the next owners' meeting as an example of Sterling Properties' operational resilience. What I was actually doing was spending 11 days building a replacement revenue model and negotiating a short-term agreement with a medical devices company that covered 62% of the lost revenue. Carla looked at the table. 18 months ago, I said. I built the rate sensitivity model for Anderson Ridge and sent it to you on a Monday morning. You forwarded it to Grant. It has been opened 41 times in the shared drive. My initials are not on it anymore. Grant said, Marisol. 11 weeks ago, I said. I flagged the DSCR covenant breach on page 4 of the quarterly summary. You turned from page 3 to page 5. 2 weeks ago, you received the formal breach notice from Meridian Capital, signed for it, and did not tell me. I closed the folder. Every time you said I didn't understand the context, I said, I was building the thing that kept the context from becoming a crisis. Every time you handed my work to Grant to present, I let it go because I thought eventually the pattern would be visible enough to speak for itself. It is visible now. My father picked up the assignment document again. He held it the way people hold things when they're trying to understand what they're actually looking at. What do you want? He said. What does this get you? Right now, I said, nothing. The cure period has 22 days left. You can cure the breach by bringing the DSCR back to covenant. I have 3 refinancing proposals already drafted. I started them 8 weeks ago. You can use them, you don't have to use them. If the breach is cured, the loan performs, and I hold a performing commercial mortgage on a Sedona resort property, which is not a bad outcome for me. I stood up. If it isn't cured, I said, I'll exercise the remedies available to me under the loan terms. Those are the same remedies Meridian Capital would have exercised. I didn't invent them. I picked up the manila folder. Grant said, You'd actually do that? To your own family. I looked at him. You sent a text message telling me I was an immediate family, I said. I'd like you to decide which answer you want to that question. I walked out. I did not raise my voice. I did not slam the door. The door made the quiet, pneumatic sound it always made when it closed on its own. Grant called me that evening. He did not apologize exactly. Grant did not have a register for apology, only for recalibration, but he asked, in a careful voice, whether I had actually sent the refinancing proposals or whether that was something I was still working on. I told him they were in the shared drive in the Anderson Ridge folder dated 8 weeks prior. He was quiet for a moment. "Okay," he said. "I'll get Dad to look at them." My father called 2 days later. The conversation was not long, and it was not the conversation I had been waiting 4 years for. But it was the first time he called me to ask me a question about the company and then waited, without saying anything, until I had finished answering it. The Anderson Ridge resort cured its covenant breach within the cure period. My father used the second of the 3 refinancing proposals I had drafted, the one with the most favorable rate structure given current market conditions. The new loan closed at a lower rate than the original Meridian mortgage. The DSCR returned to compliance in the following quarter. I no longer work in a division of 2 that is really a division of 1. My father restructured my role 6 weeks after that conference room conversation, not because he had a sudden revelation about the preceding 4 years, but because it had become logistically impossible to pretend that the debt covenant function did not require a named, acknowledged person to run it. I have a title now that reflects what I actually do. My compensation reflects it too. Grant still works at Sterling Properties. He still has opinions about brand identity and guest satisfaction scores. The difference is that when he has those opinions in a room where I am also present, he now looks at me before he finishes the sentence, which is a small thing but not a nothing. Carla and I have not had a direct conversation about the text message. I have not needed one. I have thought a lot, in the months since that conference room afternoon, about what it means to do invisible work inside a structure that benefits from the invisibility. It is easy, from the outside, to say that I should have made my contributions more visible earlier, should have pushed harder, spoken louder, demanded acknowledgement before the situation reached the point where I had to acquire a mortgage to be heard. Maybe that is true. But I think there is also something worth saying about the particular discipline it requires to keep doing careful, unglamorous, precision work in a place that does not recognize it, for long enough that the work itself becomes the argument. I did not plan what happened the way you would plan a confrontation. I planned the way you plan a sound financial position, by keeping your options open, building your resources quietly, and being ready to act when the conditions required it. The thing I have come to believe is this. The people who quietly hold structures together are not invisible because they lack the ability to be seen. They are invisible because it is more convenient for everyone else if they stay that way. The moment they stop cooperating with that convenience is the moment the structure has to reckon with who was actually holding it up. If something in this story felt familiar to you, if you've ever been the person in the room whose work only becomes visible when you stop doing it, share this with someone who would understand. Sometimes the most useful thing you can do is hand the story to the person who needs to hear it. This story is fictional and created for entertainment purposes. Any resemblance to real people, businesses, or events is coincidental.